Hi everyone, John here. Thanks for joining me for today's market rundown. In the next 3 minutes, we'll cover surging AI valuations that have the Bank of England sounding an alarm, the quiet outperformance of green equities, and a fresh twist in global oil flows as India eyes more discounted Russian crude. Let's dive in. First up, stretched AI valuations. Fed credibility concerns raise risk of market correction. The Bank of England's latest financial stability report notes that asset prices keep climbing despite slowing global growth and sticky inflation. AI-linked stocks are singled out as particularly frothy, while the BOE also points to investors questioning the Federal Reserve's resolve to hold rates high for long enough to tame inflation. Why it matters. When both equity prices and riskier credit spreads detach from macro fundamentals, history says volatility can snap back sharply. A credibility gap around the Fed could amplify that move, as policy expectations are repriced across markets. What's next? Watch upcoming U.S. inflation prints and earnings from the big AI names. A disappointment on either front could spark the correction the BOE is worried about, especially as liquidity conditions tighten into year-end. Let's move to our second story. Green stocks are quietly beating the world's biggest trades. Renewable energy shares have been outpacing headline-grabbing megacap tech and even broader commodity plays. The driver? Data centers that power large language models consume enormous electricity, and investors increasingly believe only renewables can meet that demand at scale while satisfying emission targets. Money has flowed into solar infrastructure installers, wind turbine component makers, and battery storage firms. Why it matters? The performance gap suggests ESG is shifting from a nice-to-have to a profit center, with decarbonization now linked directly to the AI boom rather than to policy mandates alone. That linkage could broaden the investor base for green projects and lower financing costs across the sector. What's next? Keep an eye on government auction prices for offshore wind and on long-term power purchase agreements signed by cloud providers. If those indicators stay firm, the rally in green equities may have further room to run, regardless of near-term rate volatility. Now to energy markets. Indian refiners may take more Russian crude as discounts deepen. With U.S.-India trade talks stalling and Russian barrels still flowing despite sanctions, Moscow is sweetening price terms for its flagship Urals grade. Indian buyers, already the second-largest taker of Russian oil, are poised to lift volumes over the coming months. Why it matters. Wider Russian discounts could pressure OPEC+ cohesion and complicate Western efforts to cap Kremlin revenue, while also giving Indian refiners a margin edge versus peers in Europe and East Asia. Lower feedstock costs may translate into more competitive diesel and gasoline exports from India, influencing refined product spreads. What's next? Watch for shipping insurance data and any adjustments to the G7 price cap enforcement. A bottleneck in tankers or tighter sanctions language could quickly reverse the discount and redirect flows. To wrap up, we have a potential equity correction flashing on central bank radar, a stealth bull market in renewables fueled by AI's power hunger, and a realignment of crude trade routes that could reshape oil pricing dynamics. For investors, the common thread is cross-sector interdependence. Tech valuations hinge on rates, AI growth boosts green power, and geopolitics keeps energy unpredictable. Keep your risk management tight and your macro calendar close. Drop your thoughts in the comments. And if you enjoyed the video, give it a thumbs up. Don't forget to subscribe and hit the bell icon. Thanks for watching. See you next time. This is not financial advice.